the last auction was March the 10th. So let's take a look at March the 10th. So here's March the 10th here. And the auction always comes out at 1800 hours, as you guys know. There's 1800 hours just there. So 1800 hours pretty much on the charts in here. So would there be any reason why there's real demand here? Well, there's a couple of things. Number one, we can look at TIPS bonds. That's always a good thing to have on these types of charts. That shows us whether there's any real demand for inflation type products. So if we were to look at, for example, TIP as a relationship to, say, the ZB contract, we can look at the inflation that's currently showing up in terms of these types of lines as well. And it's always a nice way to start considering whether there's any real demand for these yields. If there isn't, it's going to be a bad auction. And we can see that this one didn't seem to do very much at all. You can see that there was no reason why this is a good price to pay for that yield. I know it goes down a little bit, fair enough. But that's a terrible, terrible trade. Terrible trade. We can start recognizing the fact that the curve probably isn't helping anything, because obviously with the inflation aspects coming in, this looks like a terrible deal for me. I would not be interested. I would not be interested in this trade at this stage. Definitely not be interested in the trade at this stage for bonds. And obviously one of the things we can start to look at is well, of course somebody was interested because it drove down. Yeah, but it was very, 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 very obviously a bottom edge buy trade, right? It was a very obvious bottom edge buy trade from the last auction. So when you look at that and you ask the question, well, what does that do to bond prices? We can now compare it directly to a bond price. And you know what's going to happen to bond prices when we've just had that discussion, right? There was not a huge demand. So what's going to happen to bond prices? As I said, I wouldn't be a buyer of bonds inside of that environment, not in a million years. So what are you going to do with bonds that day? What are you going to be doing with bonds that night? What are you going to do the next day? You're going to be selling bonds all the way through this process. And that's exactly what happens. You can start to recognize that the bond gets a big heavy short, the bond continues to get a heavy short, and the bond sells off massively over the course of the next few weeks. Massively over the course of the next few weeks here. Beautiful sell trade on bonds from the last auction. So let's take a look at it. Let's take a look at it on the right-hand edge of the charts now. Is there going to be any demand for this real yield? Well, let's take a look at the real yields against the curve. Let's take a look at it against the inflation. So if we look at it against the inflation break-evens, we can see that real yields actually look quite perky, don't they? Do you agree with that? Real yields actually look relatively perky up here just now. If we look at it against the shape of the curve, real yields look relatively perky up here as well. So, you know, there is a case. I mean, obviously, if I could sell real yields up here, if I could sell this real yield, obviously I sell real yields by buying bonds. So you can see how much of an opportunity it would be to get long bonds here and see how much of an opportunity it would be to get long bonds here. Well, that's that process. That's that deal we've been trying to do today. That's the deal we did early on this morning where we started to buy bonds, lots of bonds, and we made a lot of money in the overnight session, $1,000 actually, on that bond trade. So when we start to recognize that these real yields at these levels are tradable, obviously that brings with it the idea that we should be very, very long bonds during those periods. We were very long bonds during those periods. It's a simple storyline to put into place. Now let's take a look at today's action and see whether, as we drill down into the lower time frames, let's see if today's action has helped us in any way, shape, or form for this bond auction. Okay, so let's take a look at first of all the London session against the bonds themselves, so that we can get a look at the London session, and then we'll obviously add in the US inflation aspects as well into this and the inflation break-evens. So when we look at the London bond aspects, we can already see the opportunity to buy this buy this bottom edge real yield. What is that buy on a bottom edge real yield? That's a sell on bonds, isn't it? Because you don't want that real yield at that price. That's the thing you're always buying, remember, when you're buying a bond or selling a bond. Do you want to have that real yield when the inflation break-evens are going up? What do you think, Nessie? What do you think, guys? What do you think, Phil? What do you think, John? You don't want that real yield, do you? It's terrible. So you do not want to be anywhere near that real yield trade at that point. So obviously that means that the real yields are going to have to get flogged. Somebody's going to have to go and sell those real yields. If we look at the interest rate curve, does the interest rate curve agree with this storyline, yes or no? The interest rate curve agrees with a storyline massively. So based on the interest rate storyline agreeing, and based on the inflation break-evens agreeing, which we'd already highlighted to you, is the problem we've got with the inflation break-evens is this rally in oil prices that's going on in the background, and this equity that's holding a bid. It's not exactly bullish, but it's holding a bid. Then in line with that, we've got to get a concession. How do you get a concession? You've got to, this is a concession candle, right? This idea of real yields is a concession candle. At this price, you've got no concession. At this price, who the hell is going to want that yield, that real yield? Nobody. And I don't even know if we've got a concession still, to be honest, guys. I don't know if that concession's actually been baked into this just yet. I think in the early stages, we could argue that perhaps we had a small concession up here. Perhaps we were still agreeing that there was maybe a concession in here. You know, taking those trades here, you know, from these real yield narratives here would have made a bit of sense, right? Selling into this one here, selling into this. Maybe a little bit of sense on the short term. But this is appallingly bad. Absolutely tragic. And as a result, there's a very, very good chance that the trade has this still in it. And obviously, what does that mean? That means that the bonds could get absolutely trashed if the demand doesn't show up. We'll put it this way, guys. There's John, there's Rick, there's Phil, and there's Nessie from the bond trading desks in the room just now. Would you, let's assume I'm putting you into the Goldman Sachs direct dealers desk, would you be actively bidding for this yield right now? Would you be keen on this price? Would you want to have that real yield? Now, obviously, that real yield, you might say, well, if I buy that real yield and it goes up, I can make a lot of money. That if it goes up, you lose money. Okay? Remember that. If you buy that, you're locking in a bond at that price. Well, that's a terrible price to lock in a bond at. If you're not going to take that deal, if that's not a deal, at the moment, this bond auction still looks like a terrible bond auction, right? At the moment, it still looks like a terrible bond auction. Now, the good thing about TradingView is we can go back through these experiences, can't we? We can go back through these experiences to look at all the previous bond auctions that we just did from the 10th of the day before. And we can investigate those same similar storylines as to whether we get any real value on a real yield narrative going into bond auctions. And the truth of the matter is, you know, this one was better than it was yesterday, this time round. This one was better because we were seeing some short-term weakness, at least in the 2s-10s curve, which means that real yield into that 1800 hours, where is it? There it is about here. You know, but look at where the real yield is against inflation break-evens, guys. I mean, it's pathetic. Absolutely pathetic against inflation break-evens. Not a hope in hell would I be interested in that. And as I said, it even went lower. But that's because the curve rolled over a little bit. But that's now massive. That's ridiculous. And obviously that resulted in this huge sell-off on bonds. Yeah, that huge sell-off in bonds. Let's take a look at the prior auction to this, which was, what month was this? March. So February the 10th. February 10th was the last 10-year bond auction prior. So here's February the 10th, and here And take a look at the bond break-evens, take a look at the curve as we came into February the 10th. Is this a good deal? February the 10th, 1800 hours, there's 1800 hours there. So would you be interested in that, that auction there? Is that a good real yield for you guys to buy into? It's absolute pathetic, isn't it? It's pathetic. So, you know, you're going to look at that real yield and say, I'm not interested in buying bloody bonds at that price. That's tragic. Absolute tragic. And what are you going to do? You're going to sell bonds. You're going to say, nope, I'm going to supply bonds into the market because this is a rank rotten price to pay. Rank rotten. So what's going to happen? You'd expect to see a collapse in bond prices, wouldn't you? Do you see how amazing that trade is, though, Nessie? Do you see that, Phil? See that, Tim? You know, just by putting yourself, I mean, a lot of you guys think that this is beyond your abilities. You're seeing the same thing as Goldman Sachs is seeing. The only thing they're seeing that you're not seeing is the ability to sell on that stock, right? So don't think you're getting any, don't think you're missing out on the debate as retail traders. You're right in the heart of this debate. This is a terrible real yield to buy an auction at. And as a result, I want to offer loads of bonds into that storyline. I think the bond will get murdered based on that real yield in February. The bond at that stage was trading a high print. You can see just in here. And obviously what happens is the bond gets absolutely murdered for 2, 3, 4, 5, 6 days afterwards, coming off of that real yield, which is appallingly bad in February. And then we get this big rally in real yields, which obviously kills the market. Now, if you're a gold trader, for example, if you're in Paul's position and you're listening to the bond traders and you're asking the bond traders, what's your guys of the treasury auction? And to be honest, Paul, that's the question you should be asking in this room for the bond traders. You should be challenging. You should be challenging Nessie and John and Tim and anybody else that's trading bonds. You should be saying to them, what's your take on this auction? Are you going to be a buyer of this real yield, or are you going to be a seller of this yield? Is this any good? Because that's going to have a big impact on whether my bond trade, my gold trade is going to be a short trade or a long trade. So obviously, when you go through that process, if I was to say, well, I'm going to sell massive amounts of bonds here. You know what's going to happen to real yields. Real yields are going to rise because you're selling bonds. That's why they rise, because obviously you need to get that incredible increase. And obviously, if I'm going to be buying bonds because of that, this is going to cause a big, if I'm going to be selling bonds because of that, this is going to be causing a big rally in real yields. And we know what happens to gold prices when there's a big rally in real yields. Gold prices usually get murdered. Gold, interest-bearing asset, of course, when there's a big rally in real yields, gold prices get murdered. So you can start to look at that and say, let's get the deal done. Let's get that short gold in play. So if we were to look at gold prices, if we managed to get any premiums on gold, for example, you could start looking at that and saying, if I could get any premiums in gold, I could probably make a lot of money going short gold during this period. And sure enough, there's your gold short, just gets absolutely crushed with this rally in real yields. And yet, as a gold trader, you were able to take advantage of that top edge, weren't you? You were able to take advantage of that perfect storyline. It's not good, it's unbelievable, but it's the process again, isn't it? It's the process that every single one of you guys should be capable of at this stage of your trading. It's just a case of asking the question, would I, as a retail trader, would I, as a member of Goldman Sachs bond buying direct dealing desk, would I buy those real yields today, yes or no? You'll find that 9 times out of 10, 95 times out of 100, you'll be right about what happens next. So therefore, challenging yourself to look at that over the course of the last day, the last week, and the last month, of course. Challenging yourself to keep going into those longer term charts and asking the question, is this a real yield that's appealing If it's not, you know what the bond trade is. Is this a yield that's appealing? If you're not, then nobody's going to want it. The bond prices are going to get murdered. The gold prices are going to get murdered. And you'll be able to take advantage of that in advance of it happening. But you should be typing it in the bloody box here before it happens. You should be doing this classroom every time you have that question to answer. Is anybody wanting to buy this real yield? And every time, if I was trading gold, that's a question I would be asking the bond desk every day of the week. Every time I'm about to do a trade on gold, I'd be saying, are any of you guys buying this real yield? Do any of you guys think this is a deal that you like? If not, I know what I'm doing on gold. I know what's happening. If you do like it still, I know what I'm going to avoid doing as a gold trader. If that real yield, if you think that real yield is going to keep going up, I know that I've got to keep selling gold. If you think that real yield is good enough to buy because it's high enough, I'm going to be very, very mindful of the fact that real yields will start dropping, and therefore I'm going to be able to buy bottom edge gold. Great little process to get into the habit of, guys, is asking the question. Ask the question from the other desk. You guys dealing? If you're not dealing, I can take a read off that. If you are dealing, might be a completely different read, guys. We're 40 minutes ahead of classroom. 40 minutes ahead of classroom, guys. That buy on volatility that I shouted did very well. Thank you for asking. We did $10.40 to $10.50. You might be laughing at the miserableness of that outcome, but nonetheless, I still made some profits. How much did you make? We did get a reversal, however, on volatilities. It ended up a little bit exaggerated at the top edge. And you can see that was a live call long volatilities. You can see what happened next. So the live call long volatilities at $10.40 traded a high price of $10.51.52s. And you can see we lost the value line on both. And that sent the volatilities packing off the highs. And that volatility that's packing off the highs was also the bottom edge of equities off the lows. Woo-woo! Amazing how that works, isn't it? If we put equities on the charts, you'll be able to see that that little reversal in volatilities, the equities made a new tested low here. The volatilities are already starting to drop, and that brings a buyer into the equities. And that's a brilliant little buy trade off the bottom of equities just in there. It's a perfectly good example of how to see easy money trades.